Welcome everybody to what we hope is going to be a bit of an epic webinar. We're hoping that you're going to be able to take away a lot of useful information. We've got two very distinguished guests with us today, and we were going to be talking about tax and accountancy and financial services. So that's the key theme here at the moment. First of all, I got a wonderful co-host, which is Susie Green, who's Susie and I have been working together for many, many years. Many of you will know Susie, and I'm going to pass over to Susie in a moment. We also too have our two distinguished guests are Mr. John Cowley, who is a chartered accountant. He will be giving us some guidance on the various aspects of limited companies, self-employment, and the taxation process and how it all works. Our second guest will be Jake Ward, who is from a company called Oakwood, who will be talking to us primarily about financial services. He'll be talking to us about pensions, how pensions work, what we should be doing, what the benefits are, and what the drawbacks are if we don't actually start a pension. And the earlier we start it, how more advantageous that will be. Susie, I'm going to hand over to you so that you can sort of have a quick conversation, and let's have a chat about the aim of the workshops. And do you want to talk about backup as well?
Yeah, sure. Should we just say a bit about who we are too?
Yes, of course.
I'll start and I'll back to you and then come back to me. Okay, so yeah, I run a peer support group called the Back Lounge. So I know I've got some loungers here. I was just taking a peek at who's joined us tonight. And I've been doing that about 5 years, which seems unbelievable. And I'm a tour manager, and I'm now a psychotherapist as well. So I'm wearing all kinds of hats. Yeah, just really pleased to be part of this tonight. We feel it's really important. I'll talk a bit more about that in a sec. Let me just hand back to you, Paul. Who are you?
I'm Paul Jones. I have a very small production company that's been running for about 25 years, and we work in live music, predominantly in the rock and roll industry. My business is solely based around freelancer staff. We don't employ anybody, never have done, never will do, because I think freelancers are the lifeblood of this industry. On top of that, I set up the live event Freelancers Forum back when they had the pandemic, which grew to, well, I would say epic proportions. We've got 34,000 members now. It's all about help and support. And this is one of the many things that Susie and I have collaborated on to try and bring some help and support. So the whole point of this today is about you guys and your help and support and what we can do to help you and give you the best guidance at a later date if you wanted to. And we'll be sharing all of their contact details about how you can get in touch with them post the session. Susie, do you want to have a chat about backup and why we're here as well?
Yeah, so Backup Tech, if you don't know them, they've been around for a long time. They kind of fly under the radar, and they're there for financial support for when people fall on hard times for whatever reason. It could be a bereavement, it could be illness, it could even be an issue with substance abuse, all kinds of reasons. So they give out hardship funding. So where this idea has come about was we were on a panel at Plaza last year with Backup Tech, and we were talking about the kind of issue with freelancers that a lot of people, when they become freelance, things become a lot less structured for them financially. And that can feel quite isolating. And I think a lot of us assume we're meant to know this stuff. But then where do you learn this stuff? So, what we hope will come out of the call today will be a kind of, fairly broad overview of the different ways you can set up as a freelancer, or you might already be set up as a sole trader and be thinking about a limited company and want to know what that means. It's also about kind of key dates, what you need to know. Hold my hand up and admit I paid my first tax bill on my credit card because I didn't know about the date when I would need to actually have some money to hand over. And that's what I mean. There is nowhere really to find this information. So that's our aim. We're trying to bring it into a realm where there's less fear around money, a bit more planning around finances.
Backup Tech are the reason that we've been able to do this. They've supported this, and we're very, very pleased that both Susie and I are ambassadors for Backup Tech as well. Backup Tech provide numerous services, everything from things like hardship grants. They offer therapy sessions, a multitude of things that they do. They do excellent work, outstanding work in our industry. So it's worth making sure that we're all aware of what exactly Backup do. Um, I think over the last few years, they've seen an increase in people asking for help and support, and this is the reason why they've approached us, and we're speaking to them, and we're doing these sessions for you. So the idea is that you can come away with this with a little bit of better knowledge, and if you need to take the knowledge further, you can then go and contact our guests directly. And as I said, we'll be passing out some information further down the line. So I think what we'd like to do, first of all, I'm going to introduce our first guest, which is John Cowley. John, first of all, thank you ever so much for your time today.
Right.
Do you want to tell us about yourself, John, and give us a bit of a broad overview about your skill set and your services?
Yeah, as you say, my name's John. I'm a chartered certified accountant. I've been qualified since 2015. I'm a partner at David Howard Chartered Accountants and have been for several years. My general client base is freelancers, consultants, small limited companies, owner managed businesses. Yeah, I've got several staff that work for me, my qualified managers. And my job today, as Paul knows, is to explain some of the basics about sole traders and limited companies.
Absolutely. I think it's not just the people that are coming into the industry, people that have just started. You know, there's a lot of people out there that have been in the industry for many, many years. You know, they've, been in the touring industry and their marriages have failed, and they're now in a position where they have no clue what they should be doing because their wife had always helped them and things like that, or their partner had helped them, So,
Yeah.
and I think the basics of this are, we come into this industry, we become freelancers, and the first thing is like, well, what do I need to do as a freelancer? We come in, we want to get set up. We know that we've got to pay tax, and this is not a political session. We could argue about where the tax money is going. But fundamentally, tax money is the public purse money. We all pay it. We have to pay it because it goes for social services. It goes towards the NHS, police, fire, all sorts of things, a multitude of things. But we're not here to talk about that. So the important thing is that we all pay tax. Now, some of
At
us
some
don't
point
want
at the
to pay
correct
tax.
rates.
Yes, yeah.
Yeah,
Some of us don't want to
absolutely.
pay tax, and that's up to you. But if you don't want to pay tax, you're on the wrong call. This is all about keeping within the guidelines so you don't get into trouble. So let's look at,
Can I add to that? I
of
guess
course
as
you can.
well, it's about yeah, as you say, it's not tax evasion, but it is about setting up your finances in the best possible way. So perhaps you might pay less tax than you would do if you hadn't set up your finances in that way. And also, I guess for me, I was a sole trader for 15 years, and then I became a limited company about 10 years ago. And I know we're going to go into the difference
Yeah.
between the two, and I might chip in then and ask questions.
Okay, well, I'll just go over a sole trader. So, as you said, Paul, the first thing you need to do if you want to get into freelancing is register as a sole trader with HMRC. That's done online through a government gateway tax account, fairly straightforward. You get issued a UTR number, your unique tax reference. You either get yourself an accountant or try and do it yourself. And every year you need to submit a tax return. Those tax returns are due by the 31st of January every year, with a tax payment as well, which we'll get onto a bit later. But generally speaking, sole traders are individuals, they're not companies, and they pay tax based on their profits in the year. And those profits are their turnover, less their expenses, business-related expenses, which I've provided Paul with a breakdown of, which I think he can probably send to everybody, but it gives you a breakdown of what we consider to be tax-deductible expenses, from costs of goods sold, wages, salaries, which don't really come into sole traders very much, but if you pay another freelancer, that's tax deductible, travel expenses, any rent and rates, power, insurance costs, repairs, phone, advertising, interest on bank loans that you might have taken out to start the business, accountancy fees. My fees are always tax deductible, which is good. But I'll get back on to that a bit later. The main thing to understand is the tax rates and how they work. Everyone has a personal allowance of £12,570, which is tax-free, national insurance free. And after that, tax is payable at 20% on anything between 12,570 and £50,270. And also national insurance, class 4 national insurance is payable at 6%. on those profits as well. So if you look at it in basic terms, Paul's put it up on the screen, thanks Paul, is that once you've earned £12,500 in a tax year, everything else after that, up to 50,000, is going to be, you've got to save 26% of it to pay the tax bill at the end of the year. Those rates aren't really changing much in 2025-26, just the Class 2 national insurance, which is payable when you do your tax return. That's going up by 5p a week, which is nothing really. And the most important thing for people that are starting out is when you do your tax return in your first year, if the tax that you owe is over £1,000, you have to pay another 50% of that as a payment on account on the 31st of January. So my main points to new freelancers is get your first tax return done as soon as possible after the 5th of April, because that gives you much more time to save, to pay the tax, and also understand that you're going to have to pay the tax half again on the 31st of January, and then half again on the 31st of July every year, payments on account, and they go towards paying your following tax bill. So that's really a basic overview of that.
Yeah. Can I ask a really quick question?
Yeah, of course.
When you submit your first tax return and you're paying your first year's tax, paid over £1,000, prospectively, HMRC will then presume you're going to earn the same
amount,
at least the next year.
Correct.
So you pay half upfront.
Yeah.
So like then if you earn less in the next year, you may get some money back.
Correct, yes. Yeah. So if you made your payments on account and your taxable income's less the following year, you won't have to pay anything else. You get a small refund sometimes. That is exactly correct. So you get the 20% bracket takes you up to 50,000. Anything you earn out between 50,000 and 125,000 is 40%. And anything above 125,000 is 45%. And at the end of the year, it can catch a lot of people out. If they've gone to 60,000, it's a lot of tax to pay. If you get to 70,000 and you have child benefit, you have children, you have to pay it back. So there's a gap between 60 and 70,000 with child benefit. You start having to repay that at a rate of 1% per £100, but I won't get into the ins and outs of it. But as soon as you earn up to £70,000, you have to repay all your child benefits. So I'm sure there's a lot of freelancers with children, as I've got a lot of clients who are freelancers with children. So that's an important thing to remember, is that child benefit does have to be repaid if you earn over £60,000 on that. So that's really basic on the sole trader front. But as I say, and I've got an example there, as Paul's helpfully put up for me. So on that example, as you can see, profits from self-employment, that's your turnover less your expenses. Say they come at £37,000, which is above the average income for a UK individual, but it's pretty standard for a freelancer that I've got on my books. Your tax bill at the end of the year with national insurance will be £6,300. But on the 31st of January, you're going to have to pay HMRC nearly 10 grand, which is a lot to do. So hence the reason I say get your tax return done early. At least then you've got time to save that money to pay HMRC. I can't really emphasize that enough.
Can you submit, or would you want to submit early?
Yeah, you can do tax returns yourself through your online government gateway account, your tax account, and you can do them anytime after the 5th of April each year. You don't need to pay the tax earlier. The tax due date's still the same, but at least you know what tax you have to pay at what date.
A couple of really good questions here, John. One that's been posed is it 20% up to your earnings of 50k, and then any income earned on top of this is 40%?
Yes. So you get the 20% bracket takes you up to 50,000. Anything you earn out between 50,000 and 125,000 is 40%, and anything above 125,000 is 45%. So it doesn't suddenly change to taxing you all by 40%. It's just the bits over that 50 grand.
And if there are any freelancers earning 125,000 or more, then please drop me an email, because I'd love to know how we do that. Another question as well is about part-time, with regards to being PAYE part-time and freelancer. So how would a freelancer go about that, being both PAYE and freelance, which is not uncommon in the industry?
No. So if you're a freelancer, a sole trader, and have PAYE, when you do a tax return, you need to report both of those incomes on your tax return. Yeah. So the PAYE, you put your employer down, the PAYE income would go down, the tax paid on the income would go down on the tax return, and then you put your self-employment accounts in there as well. The catch is, obviously, if you've got a PAYE job that's probably going to use up some of your personal allowance of your £12,570 tax-free. They would deduct tax at source on that.
I'm seeing a recurring theme here, which sounds like, yes, you can do all of this yourself, but it would be advisable, because if we're giving advice here, is to let a professional do it, really, wouldn't it?
You can make amendments to your tax returns, but it's not an easy process. We can do the amendments for you, but anything over a year, it's got to be done on paper, which is not really worth doing.
Okay.
It takes a lot of time.
And so, and on that point about using an accountant, one of the questions posed here is, what are we supposed to give to the accountant?
What I normally provide to my clients, freelancers, is a spreadsheet that they can fill out with their income, dates, their invoice numbers, the amounts they've invoiced, and then on the other side, they've got their business expenses. And then there's a page for them to note down expenses they're not sure are tax deductible. So say they bought some clothing and they say, is this tax deductible? The answer is yes, it is. But if it's safety equipment or if it's branded, it's not branded as in has a logo on that for your business. So there's a lot that comes to me. I don't like to receive all the invoices because I don't want to go through a box full of invoices and petrol receipts. I trust what my clients are giving me. If they say I've earned £50,000 and my expenses are, X amount, they've listed them out, petrol, van costs, tools, equipment, etc. I'm not going to ask for receipts. I'm going to say, okay, well, that's fine. If HMRC come and ask, you'll have to produce the receipts or proof of purchase. But I trust them on face value that that's what they've done, and I put that into the system, create the tax return as you showed earlier, and post that I email it to the client, and we discuss the tax, and if there's anything we can do to reduce that tax, any expenses they've missed, then we can talk about that before submission.
One of the things we mentioned at the start of the conversation was a UTR. Looking at UTRs, we have it regularly on the forum. People say that a company is asking for their UTR. Now, the UTR is just basically a reference for the tax office, isn't it? Should you be giving your UTR? Is what, in your opinion?
I think yes. Sometimes you take someone's UTR to check they're actually registered self-employed. So if a limited company has subcontractors that's self-employed, if you don't check their self-employment status, or at least have some proof you've checked it, and they're not registered, and then they don't pay tax, then it sort of comes back to you as you haven't checked your subcontractors. So generally speaking, most people ask for UTRs if they're in the construction industry scheme because they deduct tax, but it's a way of checking their self-employment status.
Yeah. And do HMRC ever give like a certificate to say that you're registered for tax, or do they just, is that not a service that is available?
No, they when you apply, they send you a UTR registration form which has your name and address and your UTR number on it.
Yeah. Okay.
And
so you could use that. You could use that with it's got your details on it if you wanted to give to an employer.
Right.
Can I ask a quick one, because you just referenced it and maybe not everyone knows what it is. What is an IR35?
IR35 doesn't apply to self-employment.
Yeah. What about, so here's the thing, for example, I used to sometimes do a lot of festival stuff as a freelancer, and there was a real debate going on whether or not people should be on payroll.
Yeah, but IR35 was brought in to stop people leaving the employment of a company and going as a freelancer and working for that company again. It's brought in to claw some of the lost national insurance, but with the tax rates now for limited companies, the difference between being an employee and a sole trader or limited company is very, very small. So IR35 to me is fairly useless now. And in all my years, I've had one inquiry for IR35 and it went in my client's favour. So that's how useless it is. But anyway, that's limited companies. So if I jump onto limited companies, if everyone's happy. So limited companies are a separate legal entity from yourself. They're not considered self-employment in the eyes of accountants, but the tax rates for limited companies are, if your profits are below 50,000, you're taxed at 19%. Profits between 50,000 and 250,000 are taxed on a sliding scale between 19 and 25%. Anything above 250k is taxed at 25%. And your tax payable date is 9 months and 1 day after the company year end. So not April or January, it's whenever your company is incorporated. So say your year end is March the 31st, your tax payment date is 1st of January the following year. However, you still have to pay income tax, personal income tax, on any amounts you draw out of that company. So it's not just the 19%. You still get your tax-free allowance. You get £500 of tax-free dividends, which is really not very generous of HMRC at all. And any dividends taken After that, are taxed at 8.75% up to £50,000, and then 33.75% up to 125,000, and 39.35%. But that is after paying corporation tax. So your dividends are not tax deductible. So say your limited company profits are 50,000, but you've drawn 50,000 in dividends, you're going to be paying 19% corporation tax plus 8.75% dividend tax. So you're running at 27.75% in total, which is just like being a sole trader. So I'll come on to it a bit more, but the benefits of having a limited company, if you're drawing all the money out for yourself and you're just a sole director, there's no real tax benefits anymore. They've all gone. You've got limited liability, which is great, protects your own assets, but still there's no tax benefits at all. There's one slight segment where it is beneficial. If your profits are £65,000, then you're slightly better off being in a limited company. But other than that, it's a sole trader pretty much all the way. You're better off. Your accountancy fees are more for a limited company. There's more to do. So that's it for limited companies. I mean, they're very good. If you want to employ people and grow the business, that's a different conversation. But most freelancers who have limited companies are the sole directors, and they're drawing all the money out to live on. So that's what the important thing is to emphasize today, is that the tax rates aren't beneficial. And again, when you do your tax returns, the payments on account still become due as well. So it's exactly the same as being self-employed for tax purposes, really. And the problem I find is that people pay the tax by taking more money out of the company, which creates another dividend for the following year, and that just rolls on and on and on. So it's important, again, to understand that when you're drawing money out of a limited company, you save some of that to pay the tax on those dividends.
Can I ask then, so if you are setting yourself up, maybe you're a sole trader already, you're wondering whether or not it should be a limited company. So from what you've just said, is it basically, unless you're in the region of about 65 upwards, it's not?
No, it's not 65 upwards, it's just 65. Anything below that, you're better off being a sole trader. Anything above that, you're better off being a sole trader. It's a very small window. So if the benefits are your limited liability. So if the limited company goes bust, your assets are protected. But even that, when you go to a bank to get finance, as Paul knows, they ask for personal guarantees, which basically takes away any limited liability, because if the company fails, the bank comes after you for the money, which happened during COVID for all these loans that were not going to be, held against the individuals. They were, which was another conversation. But as a roundup, limited companies for tax benefits are gone. If, however, you're a husband and wife, then a limited company can be quite good, because you can split the income 50-50.
And if you're a limited company, is that again a scenario it's even more wise to have an accountant?
Definitely, a limited company, you don't necessarily have to, but yeah, limited companies, you'd probably want to have an accountant, because you've got company accounts to do, corporation tax return, submissions to Companies House, confirmation statements, PSC registers, and your own personal tax return. So it's much easier to have an accountant to do that for you.
I think one of the things I wrote down here is, so why should we use an accountant rather than a bookkeeper? And what are the benefits and disadvantages? Obviously, you've just really named a lot of the benefits there of having an account, specifically on the limited company side. The disadvantages are quite clearly obvious, that unless you're quite legally savvy, like the things like setting up the limited company, your legal obligation as a director, and understanding that from a tax scenario, all of these things are things that you're going to have to learn. And having an accountant, I would presume, would make it better. From my personal experience, as you know, I think having an accountant is the best thing ever, because what you don't do when you have a bookkeeper is you lose that idea about what is legally taxable, what is non-taxable, what your deductions are, what you can claim for. And that's what an accountant should be really good at doing, is
I think, yes, sorry, but I think it's also important to note that a bookkeeper is a bookkeeper. They do bookkeeping, they do data processing. There are some very good bookkeepers out there. But me, as a chartered accountant, I can sign off your mortgage applications, but a bookkeeper who's unqualified cannot. Also, when looking for an accountant, always look for either ICAEW or FCCA or ACA FCA, because they are qualified accountants.
So a couple of questions from the attendees. This is a good one. What about Netflix? Is it tax deductible?
No.
Yeah, I think we knew that one. So if I spend £1,000 on fuel and have receipts for the year, can I claim the whole 1,000 as tax deductible or only a percentage?
What I would suggest, if you've got a vehicle that you're using, is you note down the mileage, the business mileage, and you charge that at 45 pence, and that comes off your profits.
Okay. Thank you very much. I do get a lot of freelancing from home, meaning I use my apartment as a working space. Does that mean that my internet, part of the rent, etc., is tax deductible?
HMRC allows you £6 a week for use of
Yeah.
home as office, which is ridiculous. That's supposed to cover light, heat, internet. Obviously, a telephone you can expense for business calls.
Are there any expenses that you can claim as a limited company that you can't claim as a sole trader?
The only ones are in a limited company, all the expenses you can claim are the same, but in a limited company, there's no personal usage adjustment for mobile phones. So you have one mobile phone per director. You can claim the full cost of that, the full bill every month without any adjustment for personal usage. Everything else is exactly the same deductible wise.
But what about PDs? Most people add PDs to their invoice. I mean, for example, if you work away from home, whether you're events or touring or TV or whatever, sometimes you get a daily payment for sustenance.
So you can if you're working away from home as a limited company or a sole trader, you can claim for meals out, well, not meals out, I shouldn't say that, but you can claim for food that you've had to have when you've had to be out of the office for over a certain amount. HMRC have got the guidelines, but if it's over 8 hours, it's sort of £10, £15. If it's overnight, it's up to £25 that you can put a claim in for, or not a claim, you can expense as a business expense. But they can be quite choosy on that because some of it come across as entertaining, especially if there's alcohol involved, they won't allow that.
So if the client says, I'm paying you a day rate of £300
Yeah.
and I'm going to give you your per diem of £25 a day, if you invoice for that, does that
Yeah.
then become taxable? It's a taxable.
Yes, it is. It will go down as your turnover. Yeah, absolutely.
Right. Okay. Fantastic. Thank you very much.
Okay.
At what point as a sole trader do you have to pay VAT? Would you have to claim VAT?
So the threshold's £90,000 of turnover. That's turnover, not profit.
Yeah.
So as soon as you reach £90,000 of turnover in any 12-month period, it's not your year, it's any 12-month period on a rolling basis. You have to register for VAT. You have to start charging your clients VAT, and then you can claim VAT back on any business-related purchases. You have to do quarterly VAT returns and pay the difference to HMRC. VAT's at 20%.
Yeah.
And what happens about flat rate VAT? Because I know, again, that can be something that...
Yeah, so flat rate VAT now for freelancers, it's usually set at about, I think it's about 16% now. It used to be a bit better, but they've set it quite high. If you've got, it's called a limited cost trader. So if you've got very limited costs, which most freelancers have, you're called a limited cost trader, you have to register it. I think it's 16.5% of the gross. So when you actually work that out, it works out 19.9%. Again, it's a conversation for another time, but flat rate scheme's not really worth it anymore at all, unless you have a lot of expenses, which most freelancers don't.
The only other expense, and we touched on it very briefly, was national insurance contributions, which are your legal obligation as a sole trader and potentially as a limited company. There are slight differences there.
Yeah.
Is there any advantage on either side for national insurance contributions? Certainly on the limited company side, if you keep your salary low and then take your dividends, you're avoiding your national insurance contributions. Yeah, is that correct?
So yeah, if you the rates have changed recently, but most of my limited company sole directors, they pay themselves a salary of 12,570, which means they're fully entitled to a UK pension, full entitlement, but they don't pay any personal national insurance. You pay employees national insurance, anything over £5,000, but as a limited company director taking dividends, you don't pay national insurance on your dividends, but you pay 8.75% tax on it. So overall, as I say, with a sole trader, it's 26%. Limited company taking a small salary in dividends, it's 27.75%. So there's no real difference anymore.
Yeah. So the law was clearly changed several years ago to, you know, to claw back. I think you mentioned it before
Yeah,
about
to
the
claw
lack
back
of
everything that was
income
missing. Yeah,
contributions.
yeah.
And obviously, the national insurance payments are going towards our pensions, which we hope that will see us into our finer years and look after us in the style that we've been accustomed to working for 40 or 50 years. Now, whether that is the case or not, we don't know. But at this point, it would be really nice to introduce Jake Ward. Jake is a financial advisor and has very many years of experience. Jake, welcome to the webinar. Please give us a little bit about yourself, please.
No, thank you. Thank you for having me. Yeah, so my name's Jake Ward. I've been a financial advisor for the last 7 years.
Do you want to give us a little bit, just a bit of an overview about pensions, first of all?
I just need to say I am a regulated financial advisor. I work for a firm named Oakwood, and we are part of a financial services network. So what that means is that in these kind of environments where we are live, I can't really be given advice as such. I can give, factual information. What is a pension? So a pension is a tax efficient way for people to save money for retirement. And this will enable people to take a regular income and enable them to stop working, which is what we are all striving to do one day. It's really important when looking at pensions to adopt a long-term mindset. So firstly, why are pensions tax efficient? So there's three main reasons. When you put money into your pension, it's in a tax wrapper. So that means that whilst your pension is growing, hopefully, over the years that you've invested it, any gain that's made on that pension plan will not have any tax on it. So you won't have any capital gains tax, for example, or dividends tax from stocks and shares investments. Secondly, you get tax relief on any contribution that's made. So in this scenario, if you're to make a personal pension contribution of £100, the government would make that £125. So you get that 20% uplift on all contributions. That's before you look at getting any growth from the fund that you might be invested in. And thirdly, when you reach your minimum pension age, which currently is 55 years, but this will be increasing to 57 come the 6th of April 2028. But you do have the ability to take 25% of your pension pot tax-free. And that, as you can imagine, is a really big incentive. Okay, so tax relief on pensions is dealt two different ways, and it depends on who is making that contribution. So the first example that we'll look at is, if you're a sole trader, you're going to be making a personal pension contribution. So any contribution you make will automatically get a 20% uplift. So for every £100 you contribute, your contribution will be gross to £125. If you're a higher rate taxpayer, then you can claim further tax relief via a tax return, and your tax band is adjusted accordingly just to get that extra 20% relief. But when you are making personal contributions, it's important to know that each year we all have an annual allowance when it comes to contributing to a pension. So currently, that is £60,000 per year, or lower if your income is not 60,000. So it's capped up to your income or £60,000. If you earn over £60,000, then you could make a larger annual allowance. Now, the other way in which you can contribute to a pension is via a limited company. So as John's just mentioned during his call, there are business expenses that you can put through. And if your limited company is making a pension contribution to you, then that does qualify as a business expense. It's made directly by the business. And instead of getting that 20% uplift that we mentioned with the personal contributions, you would receive tax relief via it reducing your corporation tax. So whether that be 19% or up to 25%. but an accountant would have to deem whether it is a justifiable business expense. So, as we say, personal contributions, they're quite easy to work out because you know how much people earn in a year, so you know what they can contribute. It's not as strict as that if you're a limited company director, because obviously your business is hopefully making profits. So the accountant would need to determine how much you could put into your pension.
So just a quick one on the, you said the difference between the 20% and the 40%. So if you're a sole trader and you hit sort of £55,000 a year,
Yeah.
does your pension contribution that you make, so if you were putting in £100 a month, does that
Mhm.
automatically mean that you get the 40% tax relief, or is it pro rata like it is, when you're paying tax? Do you actually get the physical 40% on the whole 100, or is it balanced?
Do you want me to jump in?
Yeah, and happy for you to jump in.
Yeah.
Okay, so I did have an example of this on my notes, but if you are earning over £50,000 and you make personal pension contributions, it doesn't, the contributions don't come off your profits. What happens is your basic rate band, the amount at which you pay 20% tax on, increases. So if you you earn, say, I don't know, £60,000 a year profits, but you make £5,000 in pension contributions, your basic rate band increases to £56,000. So that means you pay tax at 20% up to £56,000, not up to 50,000. So that's your extra 20% tax relief, is your basic rate band increases by the gross amount of the contribution.
Now, we will be passing notes out. We have got some notes from John and from Jake. Well, we'll be passing these on later on. So don't feel overwhelmed by all of this information. We've got a lot of wealth of stuff that we will be passing on to you. Links, contact details, absolutely everything that we discuss on these webinars.
What I will say just on that point is you get the initial 20% tax relief. You'll always get that on a pension contribution because that's how pension platforms are set up. They'll give people the relief. But it really is in your best interest to make sure that if you are a higher rate taxpayer and you are making pension contributions, that you make sure that you do your tax return, because otherwise you'll be, otherwise you could be missing out on that tax relief that John's just explained.
Yeah.
Perfect. Okay, so what I'll do, I'll just quickly talk through, the common product in the marketplace, which is a Flexi Access Drawdown Pension. I'm sure many of you have got these and heard of these, but I'll just talk through some of the benefits of why these have become popular over the last 10 years. So, as we say, it is a pension. So there's a tax wrapper, it's going to grow tax-free. And when you get to that pension age, I mean, you don't have to take 25% tax-free cash at that pension age. You can take it later on in life, at 70, 75, etc. But you have the option from 55 or 57 to take 25% tax-free cash. So not only are you getting the tax relief when you pay into the pension, but you're also getting the tax relief when you draw from your pension as well. The idea then is that your pension funds are kept invested even when you're retired. So really, it's about changing that mindset and not just thinking, I only have this, you might be 50, for example, and you might be thinking, I've only got 15, 17 years to invest in my pension. Really, what you've got the rest of your life to be investing in your pension, providing you don't spend the pot. The beauty of the Flexi Access, as it suggests, is that it is a flexible product. So whilst the money is invested, you can take as much or as little as you need when you are at that pension age. Let's just say, for example, somebody gets to 65, doesn't want to work full-time, but might want to work part-time, but needs a little top-up alongside the income that they're earning. They can access that drawdown to supplement that income until, state pension kicks in, or until they choose to fully retire. So you have got a lot of flexibility with this product. Alternatively, if you didn't want to have that flexible arrangement, you could use the funds to buy an annuity. An annuity would mean that you'll be buying a set income for life. So you do lose the beauty of keeping your money invested in the markets even when retired. But again, you have flexibility.
Quick question. What is an annuity?
Yep, sure. So an annuity is how maybe a generation before us, people used to take their pensions. They used to work through their life, build up a savings pot, and at their nominated retirement age, they'd hand their career savings over for a set income for the rest of their life. What kind of happened maybe 10 years ago with the Pension Reform Act was that annuities become unfashionable for numerous reasons, largely around losing control of your investment and also the death benefits associated with annuities. And at that point, then the Flexi Access drawdown came in, which enabled those benefits to kind of address those benefits. So the fact now that you don't lose control of the investment, you can keep it invested, and also death benefits at present are far greater with a drawdown pension than they are with an annuity. Does that help?
It does. Can I ask what might be a stupid question? So where do you get a Flexi Access drawdown pension? If you're a freelancer and you think, okay, it's about time I get one, how would I go about doing that?
Yeah, well, most people would get in touch with someone like myself, a financial advisor, and start that journey if they wanted an advised service, that is. However, there are going to be many platforms out there, I presume, that would enable people to set up their own pension just without the advice element. Okay. And just onto that final point, it's just important for me to reference this. So it's just important for you to know that pensions are taxable. So, and this is not sometimes forgotten when people are thinking about retirement planning, but you get tax relief when you put into a pension. You get your tax-free growth. You can take 25% of your pension pot as tax-free cash, but the remainder would be taxable subject to your marginal rate. And if we think about it, you know, if you're all on target with your national insurance contributions and you are set to receive a state pension, at present that state pension is going to fill most of that £12,500 that John's referenced earlier as your personal allowance. So it's likely that most of your pension that you may draw through this through any source, whether it's a drawdown pension or an annuity, that is going to be taxable. But don't forget all the tax incentives that you've had up until the point where you get to, you know, draw in the remaining 75%. Okay, so when we look to set these pensions up for clients, we do need to establish how comfortable our clients are in investing and what level of risk they are willing to take. So normally there'll be 3 risk levels: cautious, balanced, or adventurous. And really, the main difference between the 3 is just how much exposure to companies your investment has. So cautious funds will normally have about 40% of the investment in companies, turn the stocks and shares market. Balanced, you're looking at nearly 2/3 of your investment, so about 68% would be in stocks and shares. And adventurous, you'll be looking at around 92 to 95%. And I have some examples. So this data is from the end of February. And what this shows is how a cautious fund, a typical cautious fund that we work with, has performed over the last 5 years. Now, as I referenced earlier in the call, we have had some real volatile times in the last 5 years. And just looking at that graph, you can see obviously it starts at a low point with lockdown and COVID. It's obviously recovered. It's hit another low point in Feb 22, which was around the time of the Russia-Ukraine invasion. It had a bit of a pickup mid-22, and then we had the mini budget with Liz Truss, which did rock markets, and then we've had a period of recovery since then. And last year was a really good year. American tech companies and AI really drove markets forward. But this graph here, as I say, it's for cautious. So only about 40% of this investment is in companies. And when we look at investments, we are looking at the long term, as I mentioned. So if you look at that 5-year figure, you can see it was just over 11% cumulative growth over the time of the investment. And I think anybody who's cautious probably appreciates, they're not going into this to get great gains, maybe just something that can keep up with inflation and get the tax benefits along the way of being invested in a pension. Well, I'll move on now to the balanced. So again, you can see that the graph moves in a similar way, but you have more equities and companies and stocks and shares in this investment portfolio. And you can see that 11% is near 30% over the 5 years. Again, markets have peaks and troughs, as we know, all the time, but it's that composure piece that's really important. And I'll move on now to the adventurous one, which, as you can see, again, similar kind of journey, but where people are taking more risk and being adventurous. You can see that in this instance, the reward has been greater. And over the last 5 years, they're close to 46% cumulative growth. So another really important area when investing. So we establish risk and then we look at diversification. So that essentially means that you don't put all your eggs in one basket. And the best way to spread the risk of an investment is by spreading where your money is. And that is via looking at different geographical regions, asset classes, market sectors. And in addition to that, you want different people looking after different areas of your investment. So as you can see here, some of the names that just run down the side there. So we've got an all companies fund, we've got UK smaller companies, US equity leaders, US smaller companies, and so on, right down to things like bonds and gilts, which are loans to companies and to government. So they're not necessarily going to be driving your investments forward as much as equities, but they do serve a purpose and provide a bit more of a steady return for less adventurous investors. Okay, so just before I wrap up, I thought I'd put together a bit of a case study just to try and bring this to life for you. So I'm using a mystery man here named Joe Public, who's 30 years old, self-employed, and he is a sole trader. And Joe earns 30k per annum. And he has decided that he wants to start investing £200 per month into his pension. So as we might remember from a previous slides, with him being a sole trader, he will be making a personal contribution into his pension. So he will be getting that 20% uplift, and he will be putting a gross amount of £250 per month into his pension. Joe is adventurous. He sees that he's got a long time to invest this money and that he feels that he can ride out any dips that may happen over the course of his investment. His anticipated retirement age is state pension age at 67. He currently needs £20,000 net of tax per year to live and cover his share of the bills. And he wants that same standard of living in retirement. And he's also earmarked that he wants to take his tax-free cash at retirement, so when he's 67, because he wants to book some holidays in and he wants to buy a new car. What we do is we put a plan together and then we create a visual aid for Joe so he can see his potential journey. So we know he earns £30,000 per year. So what this graph has done is factored in the fact that he's going to be paying some tax and national insurance on that. So as you can see, he can just about meet his 20k target each month. And he ticks along doing that right the way through until his 67th birthday, where he decides then that he wants to have a big blowout and spends a chunk of his money. So what you can see there is that at 67, that blue line shows that the state pension kicks in. The amber bar, his savings, is representing his tax-free cash. I think he's got about 80 odd £1,000 that he's going to be drawing. And then in addition to that, he's got his the pink is his drawdown pension, which is covering his monthly expenditure, because where he's retired, I can't remember when I said Joe's birthday was, but he hasn't. But he's, as you can see there, he's got his blue line, his pink line, and his amber line for his tax-free cash. And if Joe manages his money well, as he's expecting to, then you can see that Joe will be able to spend his drawdown pension right the way through to his 92nd birthday. There is a shortfall because Joe's mortality is obviously expected to be 96 by this graph. However, you know, this is stage one really of putting a cash flow modeler together for a 30-year-old. And this is something that I'd revise with Joe each year as his career progresses, as his contribution levels might change. And then we can start that financial planning journey. But a visual aid can sometimes be really powerful when working with people.
I'll just butt in quickly and say,
Yep, sure.
My version of that graph you just showed is I didn't pay into a pension until very recently. And hence, the news is quite depressing when I meet with the finance guy once a year and he tells me, you're probably going to have to carry on working. So, yeah, just, I guess, to say, you know, not as a kind of, and let that be a lesson to you, but it's only now I really realize how important this stuff is and how important is things like, you know, given how volatile things are, especially at the moment, and how uncertain things are, and looking at things long term, you know, things will balance out again, but then who knows when the next uncertain bit is. So just getting into that mindset of longevity, which might seem a million miles away when you're 30. I know it certainly did for me. I was very impressed with Joe Public, knowing he was going to have a few holidays in a car when he retired. I'd be thinking, yeah, I want to do that next year. When can I get my hands on the money? So, but the point is here, isn't it? It's just thinking beyond the end of next week.
Yeah, it's definitely long term. It's about building a behavior and a habit, I would say, of, you know, making sure that you see your pension as just another bill that might go out, you know, albeit it's one that's going to give you money at the end of it. So yeah, and you know, essentially it is wealth. You know, you are creating wealth with a pension. You know, no matter how big or small that might be, it's still something that's an asset to your name. So it is important to prioritize and grow. So that gives you an idea of how cash flow modeling works.
I think one of the really resounding ideas there is when you look at this graph, what you can see is that you've got the state pension, and it was a really valid point that you made about your pensions are taxable. It's good to see the fact is that you've got a private pay, I've got personal pension plan, but you've also got your state pension because you've been paying your stamp or you've been paying your national insurance contributions. But that means that if you didn't have a state pension, then your pension pot would be less liable for tax. But because you've got the state pension and your pension pot, then some of that is going to be liable for tax, albeit at the lower rate of tax, a 20% rate of tax.
Yeah.
So that illustrates that really well. The second thing is, just to reiterate what Susie says, is about the importance of starting these things when you're young and saying, well, I can't, and most people will say, oh, I can't afford it. And it's like, but you can't afford not to, because if you do nothing now, if you're 25 years old, for instance, and you do nothing now until you're 55, that 30 years would make a significant difference just by looking at this investment here on what you get in your retirement, which will mean that you'd have a better retirement, because we don't know what's going to happen with retirement age. It's already at 67. If you're 25 now, you could find that the retirement age is 75 by the time you get. We have no way of knowing, you know. So I think it's really great that we can illustrate the points here about how important it is to start this journey sooner rather than later. Would you agree that's a good thing to do? Start earlier and start putting money away whenever you can.
Yes.
I think everybody on this call will say they wish they had started planning for their pensions sooner. Probably the minute they walked out of school, they
Yeah.
probably wish they were squirreling some kind of money away, because it's all about that long-term compounding interest that you get on the plans. And I go back to this, this is just 5 years, but could you imagine, you can see them jumps there. If I had access to show you 10 years, 15 years, I mean, these funds aren't that old, but you get the idea, that would really show you how money grows over time. And these percentages aren't factoring in that tax relief either. So straight away, you get a 20% growth on an investment, plus whatever the compounded interest is over the decades that you keep it in the pension wrapper.
Yeah.
And Joe here, you don't need to take 25% all in one go either.
Yeah.
So you could spread that tax-free cash out over a few years, or you might not want to take it until, a certain age. But as I mentioned, it's the great things with the drawdown pension are the flexibility, the ability to keep the money invested in the markets, keep it growing, and draw as much or as little as you need from it. So yeah, hopefully that brings that to life.
One of the questions, sorry, just to before you move on, one of the questions that has been posed here is, at the end of your life, is pensions pet saving pot part of your estate to be left to whoever you want to inherit? What happens to your fund when you die?
Yeah, that is a contentious area at present.
Either I can jump in or Jake can do this because it's changing. It is changing.
Yes, it's changing. So at present, these drawdown pensions would be sat outside people's estates. So pensions have been over the last few years, 10 years, inheritance tax at all, because the advice has always been drawn on your other assets like ISAs, cash, etc., and then spend your pension at the end because it doesn't form part of your estate and would pass to the beneficiaries free of tax. But come 2027, Rachel Reeves is trying to put pensions into people's estates. So it's a bit of unknown territory at the moment as to whether she'll be successful with that or not. Pensions are written into trusts, so it could be quite difficult for her to do that. But working with the laws as they are at present, the drawdown pensions sit outside people's estates. However, in 2027, that might change. Did you have anything to add to that, John?
No, that's exactly correct. Yeah. And I think it's important to note that, as it stands, being inside or outside your pension, whoever takes over the pension would pay income tax at their marginal rate when they draw down on it.
Another thing as well is, I know it sounds a bit scary saying pensions may form part of people's estates, but at present, say a married couple who own a house, let's say, they do have a nil rate ban of £1 million. So there would need to be, substantial assets for an individual for the pension to have, to have potential inheritance tax on it. But again, it's all we don't know if it's going to be successful or not. We hope it won't, because it's, as we said, it's a good inheritance tax tool, and it's great for people to have an asset that can be held outside their estate. But secondly, again, it all comes down to individual advice and what's right for that individual and their circumstance at that time in 2027. Perfect. Okay, so that concludes my presentation. I know there's some questions that I need to pick up, one about ELISA as well, but the key takeaways from this are that pensions really need to be seen as a long-term savings plan. You get tax relief when paying in, and you get tax relief when accessing your plan. You need to ensure that you link the investment to your chosen risk level, so you're comfortable with the investment, and understand how diversification is really essential for spreading the risk of your investment. And forecast, so you don't have any surprises when you do get to retirement. So I will put my details there. And I think there was a question on LISAs?
Yes, there was. Is LISA a bad idea because it does not keep up with inflation, and so your money is not worth as much when you get access to it again?
So ISAs, similar to pensions, in the fact that they go into a tax-free wrapper, so you get tax-free growth on them. But in this instance with the LISA, I believe it's just the uplift that you receive. So, I mean, versus like a standard cash ISA, if you are getting, you know, that £1,000 a year for putting £4,000 in, you know, that's going to be generous versus any other ISA that might give you a 5% annual return, which is £200, for example, on £4,000 being put in. They're better in that respect, but yeah, I think if you're looking at a LISA as a means to save for a pension, then you might want to consider doing further investments in stocks and shares. I guess the LISA is a safer way to invest because you haven't got that investment risk as such. You've just got that bonus that you know is guaranteed, providing you put X amount in.
And at risk of sounding stupid, but I'm way beyond that now. What is the difference between a LISA and an ISA, or is it some sort of version of the same thing?
The LISA is an extension of an ISA. So each year, an individual has £20,000 that they can pay into an ISA. But if you wanted to, you could pay 4,000 into a LISA, which is a lifetime ISA, and you can get a 25% uplift. Yeah. So you can get the £1,000 bonus, which is a good incentive, but like I say, probably more cautious individuals. But with the ISA as well, it's tax-free income. So, you know, when you do come to draw on that, you're not going to be paying tax on that income. So yeah, versus a cash ISA, the LISA is a better investment vehicle because of the benefit. But when you learn that you can get the same uplift in the pension wrapper, plus you can invest it in global markets, plus, you know, you need to lock it away anyway, like you need to lock away the LISA. I think the only difference really would be LISA might suit somebody who's more cautious because they don't want to invest their money in markets.
Can I ask then, what happens if you have been saving some money, you know, whether it's ISAs, LISAs, whatever kind of pension pot, and you need to get access to your money for some reason? You've fallen on hard times. How easy is it to do that?
ISAs are accessible. It depends on what the T's and C's are of the investment, but generally, cash ISAs that have like these fixed interest rates, you might need to lock it away for a period of time and then you can access it. The LISA, again, the idea is that you lock it away and you don't access it, but if you needed to access it, there's a penalty, I believe, on the LISA. And the pension, you can't access that until your pension age. If you did need to access it, then you'll be paying a tax charge of around 55%, I believe. So it is quite punchy. You could, you know, do stocks and shares ISAs where, you know, it's instant access, for example, where you can just put money in and draw it whenever. But I think the message that we're trying to get across today really is that with cash that you're putting away and investing for the future, you probably just need to be comfortable that you need to give that time to grow and do its job and help you out later on in life. So maybe, you know, having an emergency fund would be a good idea, a savings amount that you could call on in hard times, and know that what you're saving for the long term is exactly that.
Brilliant, thank you. I've got a really good question here, which is, I'm 51 years old. I've accumulated several pensions from organisations or fixed term contracts. I've had these over the years. I've no idea how to manage them going forward, and I don't know what they're worth in total. Is there a way to merge them? What should I do? Where should I go for help for this?
Yeah, sure. So that's a big part of what we do for our clients when we you know we're meeting new clients and onboarding new clients. We do a pension consolidation job. So for us, we would require plan details, a pension provider, pension plan number, and then we would write off to those different pension companies and get up to date illustrations in. We'd analyze those plans, and then we would come to, you know, X client and give them like an overview of the plans that they have, and why it might be worthwhile then looking to consolidate and move them onto a platform that we manage. But yeah, I definitely think, it's anyone that has different pension plans in the background and doesn't really know what's going on with them, to go through a process where you can get some analysis done and potentially have an ongoing service with an advisor is far more beneficial than just leaving it right up until you're in your 60s and thinking about retiring soon.
So pretty much the same as what we discussed with John is that you should always seek professional advice, not from Dave down the pub or from somebody on Facebook because they've done their research. What you need to do is go to somebody like yourself for the professional advice that can say, well, let's have a look at what you've got and let's see how we can manage that best suits your investment ideas and what you want to do and what you want to achieve in life.
Yeah, exactly. Yeah, it's all the advice that we deliver. Will have the client's best interests at heart. All advisors should operate like that. So, yeah, it's just about understanding the client, what they have at present, what they are looking for from retirement, and then just trying to get a plan together where it usually makes sense to do the consolidation job. Get it on a platform that is managed, and we can work with individuals on a yearly basis.
Brilliant. One last question, because obviously time is getting away with us, and we don't want to hold everybody up. But the last question is: I have an Aviva pension from my previous employment. Should I keep that if I go into sole trading?
Should you keep it in terms of?
I think
it's yours. The pension's yours, so you will be, it'll be there in the background. I guess it's whether you're saying, is it worth making contributions into that Aviva pension?
Yes.
Which you can do, but what I will say is that you're not going to be getting any advice if you're not comfortable with pensions. You might not understand how that Aviva plan's invested, what benefits it's got, what death benefits it's, what funds it in, does it match your funds as an investor? So Aviva is a fund that we do often mop up when we work with clients, but there's no reason why, if you didn't want an advice service, why you couldn't keep that running and just reroute your contributions from self-employment into that fund.
That's fantastic. I know that the government HMRC have a section on there. We've got a link for people that if they wanted to go and to look at whether or not what the pension pots are worth, how they do that, about consolidation and all of these kind of things. But also the point of having our two guests on today has been to give you some guidance. So apologies, not advice. But the idea is if you want to contact either Jake or John, you're more than welcome to. We will be handing out some details to everybody that has been on the call, everybody that signed up for it. I certainly think that would be a really good idea. I'd like to thank everybody for coming along, especially our two guests, because I think what we've covered in the last hour and a half has been quite phenomenal. And I think there's a huge amount of information there.
We have another call on the 15th, which we're calling Staying Out of Trouble, which is very much about kind of money worries, debt management. If you get into debt, which bills should you pay first? This kind of thing. And also insurances, because insurance around PLI, various different things that should you have, shouldn't you have? A little bit of clarity about those. So we have two guests on for that. And then our final call is about the legality as well. Contracts, which is an alien thing for many people working freelance in music, specifically terms and conditions, how you can start protecting yourself, and also the culture of money and the fear of money, which might sound like a strange thing to try and talk about, but I think it's just really telling how much interest we've had, how many people have signed up for the recordings and for the call. And people don't like talking about this stuff. It seems to be this thing, like it's a dirty word to talk about and think about money. So we've got really amazing guests coming up. So please sign up if you haven't signed up already. And also, if everyone is happy, we'll share our resources to everyone who's signed up for the calls.
I think all that's left to say is just to, on behalf of Susie and myself, We'd like to thank you all for coming along, first of all, coming to join the webinar. I hope you found it resourceful. But real big thanks. I'm very pleased that we've had both John and Jake on here today. We've covered quite a lot of ground. Obviously, you can contact these people directly if you so wish. We will send out details. Just a gentle reminder that, as we've said, we are giving guidance, not advice. In order for somebody to give you advice, you need to have professional indemnity in place, and both people like John would have that in place. Financial advisors would have these things in place so that they can give you the best possible advice. So you need to be a client, so you need to sign up with people. So if you're looking just for a way to simply reduce your tax bill, John might not be the person to speak to. But if you're looking to get an accountant to help you reduce your tax bill, then John might be perfect. The same goes for Jake. If you're looking to start your investment portfolio and move forward with that, no matter what age you are, whether you're 25 or 65, as Jake rightly pointed out, you know, if you've got good health, and many of us in this industry work well into our 70s, you could still quite easily be, turning a pot into for 20, 25 years. So that could give you a decent retirement. So bear all of these things in mind. But I think all that's left to say is thank you very much to our guests. Thank you for Simon, the unsung hero in the background, who's been monitoring all of the webinar chat and doing the Q&As for us. And also to Susie, my amazing co-host, who is absolutely brilliant every time I work with her. So thank you, everybody. Susie, I'll leave you to say goodbye.
Thank you so much for coming. Also, just to shout out to Backup Tech, who have allowed us to do this. Please look them up. If you don't know them, you should know them. They are the most incredible charity. So thank you.